Welcome to another session of the My Solo 401k Financial weekly YouTube series. We have a great topic today, which is the 2024 and 2025 Solo 401k contribution limits. If you're on YouTube, please like and subscribe. Of course, also please feel free to post comments or questions as we'll go through those at the end of the presentation. So let's jump into it. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor is a solicitation. When making an investment decision, please consult your tax attorney and financial professional. We host daily Zooms on our community, mysolo401k.net/my community. So office hour style Zooms are hosted throughout the week at 1 p.m. Pacific, 4 p.m. Eastern. It's always free. Videos and webinars where you can learn deeply on many topics. So it's a lot of great ways to learn and to share the knowledge. Before we jump into today's topic, we want to lay the foundation just with some basic understanding of what a solo 401k is in terms of the benefits and features, as far as well as eligibility and some of the top use cases. So as far as the benefits, how can our solo 401k plan benefit you? Well, there's a number of benefits, and you can easily find this on our homepage, mysolo401k.net. But we'll touch on a few of these benefits, including the fact that our plan supports fast account setup and funding, including opening and funding the account in as fast as 1 business day. Of course, all different types of contributions, whether you're trying to reduce your taxable income now by making pre-tax contributions, or whether you're looking for tax-free growth. In addition, the solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. So for those folks who might be behind on their retirement savings, it's a great vehicle to be able to catch up on retirement savings. Moreover, because of our low cost structure, that will really allow the self-employed individual to preserve their retirement account balance. For example, we have a 100% flat fee structure, including a flat $125 annual fee. There's no asset under management fees. We prepare the paperwork or help customers open online brokerage accounts or bank accounts, which are all free accounts. In other words, the financial institution is not charging anything to open up the account or maintain the account. And lastly, and which has a tremendous impact on the cost, is that our plan will make the self-employed individual eligible to claim $1,500 in solo 401k tax credits, which would more than cover the cost to set up and maintain the plan for the first 7 years. It will more than cover the cost to set up and maintain the plan for 7 years. Lastly, you can invest in what you want in terms of being able to invest in not only traditional brokerage type investments like stocks, bonds, mutual funds, but also true alternative investments such as real estate, private placement, private stock, precious metals, etc. In terms of some of the top features of the plan, or I should say in terms of additional benefits, just to quickly highlight, the account setup and the account is quite easy to use because we're very hands-on in helping customers open up the accounts at the bank or brokerage of choice. There's also the ability to integrate with your payroll. For example, if you are paying yourself via payroll like Gusto or ADP, just to name a couple of the payroll integrations. With that payroll integration, you're able to set up automatic recurring contributions, automatic recurring loan payments. The plan does allow for emergency funds access, where you can access the funds tax and penalty free via a solo 401k loan. As mentioned above, it's a flat $125 annual fee that covers all the ongoing compliance support for the solo 401k, and then tremendous educational resources such as the community that we mentioned, online forums. We have a AI as well that will help you find answers and answers to questions as well as resources quickly 24/7. In terms of some of the top features, we've mentioned a couple, but just this page gives a great resource as it puts it all on a list there for you. And again, you can access all of this on our main homepage. There's a link at the top at mysolo401k.net. Now let's talk about eligibility. So, and I see that there's a good question there about eligibility. A solo 401k plan is for a self-employed individual. So in order to be eligible to set up a solo 401k, you need to be self-employed with no non-owner, non-spouse, full-time W-2 employees working for you. So think like an independent contractor, a solo practicing professional like an attorney or CPA. Again, the key is that you don't have any non-owner, non-spouse, full-time W-2 employees working for you. In terms of some of the top eligibility considerations, you do not need to have a formal legal entity. For example, we have many customers who operate as sole proprietors. Of course, if you do operate your business through an entity like an LLC or an S corporation, that's fine, as long as you are reporting earned self-employment income on your taxes. For example, Schedule C for a business that's taxed as a sole proprietorship. For example, a single member LLC that's taxed as a sole proprietorship, or W-2 wages. For example, if your business is taxed as an S corporation or a C corporation, and then again, not having any full-time, non-owner, non-spouse W-2 employees working for any business that you own or that's owned by a spouse, if any. So there's no minimum amount of earned self-employment income that you need to report in order to be eligible to set up a plan. But if your goal is to make contributions, your ability to contribute is going to be a function of that earned self-employment income. So you may not be able to contribute a relatively high amount, but you could still set up a plan. You could still roll over funds from a pre-existing retirement account, such as a former employer plan or a non-Roth IRA, and then take advantage of the other features, such as the ability to invest in alternative investments or the ability to take a 401k loan. Your spouse or business partner may participate in the solo 401k as long as your spouse or business partner are reporting their own earned self-employment income, such as their own Schedule C or their own W-2. You may set up a solo 401k even if you have a W-2 job, even if you participate in your W-2 employer-sponsored plan. Again, as long as you've got that separate earned self-employment income. So now just to illustrate how individuals are using our solo 401k plan, we'll go through a couple use cases, looking at it through the lens of certain customer profiles. So the frugal investor will be attracted to our plan because setting up our plan is going to make the self-employed business eligible to claim $1,500 in solo 401k tax credits, which is going to more than cover the cost to set up and maintain the plan for the first 7 years. Our fees are $650, which includes the $525 establishment fee, plus the first $125 annual fee. And then starting 12 months later, we charge our $125 annual fee that covers the second year. Again, it's a totally flat fee structure with no AUM or asset under management fees. Another great use case would be the Roth Maximizer. So with our plan, you're going to be able to make not only Roth and mega backdoor Roth contributions, but you can also process in-plan Roth rollovers, where you convert pre-tax money that's already in a retirement account to a Roth status to further maximize the funds in your Roth solo 401k, where you have the potential for tax-free growth. The large account holder, once the value of the plan exceeds $250,000, there's going to be an informational tax filing requirement and the name of that filing is referred to as a Form 5500EZ. We handle that Form 5500EZ, including preparing and filing under the electronic filing system, the EFAS system, to make it easy for the customer. The alternative investor. So our plan is going to, of course, not only allow for traditional brokerage type investments like stocks, bonds, mutual funds, but also, as mentioned up above, alternative investments like real estate, crypto, private placement. The rainy day investor. So our plan is going to allow the self-employed individual to take a solo 401k participant loan, where they're going to be able to borrow up to 50% of the balance, not to exceed $50,000, and then use those funds for any purpose whatsoever. So as described up above, it could be an emergency purpose. And that's not going to be subject to taxes or penalties as long as it's within those loan terms and properly documented as a 401k loan. So we handle those loan documentation requirements as an optional free service for our customers. We do that within one business day when someone submits our online form to request that loan documents be prepared. So now let's go to the 2024 and 2025 contribution limits. So for 2024, those contribution limits, the overall limit is $69,000 or $76,500 if you're 50 or older, because you're able to make a catch-up contribution. Now, this, of course, requires that you have the self-employment income to justify these contributions, right? You can't save more than you earn. But assuming you do, these are the overall limits. Now, for 2025, the IRS recently announced increases to those contribution limits. So, first of all, they increased the $69,000 overall limit to $70,000. The catch-up contribution for those age 50 or older remains at $7,500. However, for those who are age 60 to 63, their catch-up contribution limit is higher. Instead of $7,500, it's $11,250, which is how someone who's age 60 to 63 may be able to contribute up to $81,250 as a solo 401k contribution for 2025. Now, that's the overall limit. There are different types of contributions that can be made to a solo 401k. For example, there are employee contributions versus employer contributions. And so there have been some changes to the employee contribution limits from 2024 to 2025. So let's first review the 2024 limits. So for 2024, the employee contribution limit is $23,000. That now has been raised up to $23,500. And because the overall limit went up by $1,000, remember from 69 to 70, this effectively means for someone who's maximizing that employee contribution, their employer contribution limit went up likewise by $500. Again, the catch-up contribution limit for those age 50 or older stayed the same, with the exception that if someone is age 60, 61, 62, or 63, their catch-up contribution limit is higher. They'll have a bonus catch-up contribution limit. Instead of $7,500, it's now $11,250. So it's helpful to mention that there's still time to set up a solo 401k for 2024, right? We just looked at the 2024 limits as well as the 2025 limits. So if you don't have a solo 401k, you can still set up a plan by the end of 2024, which will preserve the ability to make all types of contributions for 2024 up until your business tax return deadline, including any timely filed extension. And we make it quite easy to meet the deadline because all you need to do is sign up with us by the end of the year. That's what will create the plan. Once the plan has been established, that will preserve the ability to make those contributions by the business tax return deadline, including any timely filed extension. So creating the plan is just a matter of signing up with us. And really, it's just 3 steps. You complete our quick 1-minute online application and make payment. We will then draft the solo 401k documents within the same business day. You'll then receive an email with a link to our secure portal where you'll be able to download the documents and sign the documents, and that's it. You can take your time in 2025 to return the documents, to open the accounts, and make the contributions. Again, all the way up until your business tax return deadline, including any timely filed extension in 2025. And as mentioned, we are very hands-on in helping customers open up the requisite number of accounts at the bank or brokerage of choice, as well as providing tremendous support in terms of helping them understand how the contribution limits apply to their specific situation, et cetera, et cetera. So yes, the business tax return deadline, including any timely filed extension, is the 2024 deadline, as long as you sign up by the end of the year. So as mentioned, it's the business tax return deadline. So it's really going to be driven by how your self-employed business is taxed. For example, if your business is taxed as a sole proprietorship, you would have until April 15th, really your 1040 deadline, or October 15th if you file a timely extension. Again, as long as you sign up with us by the end of the year. Whereas, for example, if your business is taxed as an S corporation, it'll be the S corporation deadline. So March 17th of 2025 or September 15th if you file a timely extension. And then for 2025, that extended deadline will continue, right? So again, it'll be driven by that business tax return deadline, including any timely filed extension. So as always, you can continue to follow the conversation on our community, mysolo401k.net/my community. It's always free to join. All are welcome. Now we want to go to the good questions that you brought. Thank you so much for your participation and patience as we went through those slides. So it's definitely good news, like the ability to contribute and save for retirement is only going up. Okay, so now let's go to the questions. I have a solo LLC and wife has a freelance business. Can we both open separate solo 401ks, or it has to be one combined solo 401k? That's a great question. So if you have 2 spouses who really have their own separate businesses, then it'll be a separate solo 401k for each spouse. So spouse number 1 would have their solo 401k sponsored by their LLC, and spouse number 2 would have a solo 401k sponsored by their separate business. Of course, the requirement is that each spouse is reporting earned self-employment income, and neither spouse has a business with full-time, non-owner, non-spouse W-2 employees. So thanks so much for that great question. Thanks for bringing it. How do you determine if someone is qualified, considering things like pro rata, among other things, for people that are not financial savvy? So, well, the qualification really just comes down to being self-employed, right? A 401k is for an employee that works at a company that offers a 401k. A solo 401k is for someone that's self-employed with no non-owner, non-spouse employees working for any business owned by that person or spouse, if any. Now, in terms of the pro rata rules, I'm assuming you're referring to the mega backdoor Roth, because that question comes up sometimes in the context of a mega backdoor Roth. And the ability to make mega backdoor Roth contributions is one of the top reasons that customers sign up with us. And that's in contrast to a backdoor Roth IRA. So our plan, our solo 401k plan, would allow for mega backdoor Roth solo 401k contributions. And there's also the ability for some folks to make backdoor Roth IRA contributions. So the pro rata rules apply differently to a 401k versus an IRA. With an IRA, the individual has to look at all the IRA account balances that they have in determining those pro rata rules and how they apply. Whereas with a solo 401k, the pro rata rules apply at the account level, which is why someone could have pre-tax, Roth, and after-tax funds in their solo 401k held in separate accounts, and that individual could just transfer the voluntary after-tax solo 401k funds to a Roth solo 401k or Roth IRA, notwithstanding that they also have pre-tax and Roth funds in separate accounts for the same plan? So that's a great question. And that's the type of question that we're fielding every day from our existing customers in terms of guiding them through those mega backdoor Roth procedures. All right, next question. Does the, oh, I think we might have skipped one. I'm so sorry. We'll get to that one in a second. If we already opened a solo 401k for 2024 and make contributions, including mega backdoor Roth in 2025 before filing our taxes, what are the tax implications? Just changes to Form 8606? Well, that Form 8606 would not be issued by the solo 401k. The solo 401k would need to, a 1099-R would need to be issued to report the after-tax to Roth transfers. So if someone made after-tax contributions, for example, in 2024, and then transferred those funds to a Roth IRA, there would be a 2024 1099-R, and then the Roth IRA provider would issue a corresponding 8606. And then if the individual made additional contributions in 2025 and then transferred those voluntary after-tax funds to a Roth IRA in 2025, there'd be a 2025 1099-R. So the 1099-R is not issued for the year for which the contributions were made. It's issued for the year for which the contributions were transferred from the after-tax account to either a Roth solo 401k or Roth IRA. So in that situation, there may not be any 8606 implications, because likewise, the 8606 is going to be issued based on the year. Hopefully that helps explain and shed light. Thank you so much for the good question. Does the Form 5500 have to be filed if the individual account reaches $250,000 or when your combined accounts reach $250,000? So you would need to look at the combined accounts for the plan. So the individual would not look at IRA account balances, for example, but if they had pre-tax and Roth funds in that one solo 401k, or let's say that there was multiple participants, like a husband and wife, both participating in the same solo 401k, but with their own separate sub-accounts for that one plan. You'd have to look at all the account balances as well as any the value of any alternative investments that were held in the plan. And if the sum is greater than $250,000, also considering any defined benefit account balances, that would have to be factored in determining whether the threshold has been met as well. But if that value then exceeds $250,000, clients would want to let us know. They would just simply let us know, and then we would add them to the queue to prepare that Form 5500 EZ, which again, we handle as an optional free service for our customers. We do it under the electronic filing system just to make it easy for the customer. But yes, so you look at the entire account plan value, I should say, looking at all the different accounts. So the entire plan value, looking at all the different accounts. Next question, are there two separate deadlines for employee and employer contributions, December 31st for employee and April 15th for employer, respectively? For a self-employed person, no, they're not. And that's a common point of confusion, because in the context of a, say, full-time employer plan, like one might have if they had just have a 401k through their W-2 employer, the employee contribution in that case is the end of the year. The employee contribution deadline is the end of the year. But the rules are different for self-employed individuals. For self-employed individuals, there's more time to make contributions. And this is clear under IRS Publication 560, which is the landmark guidance for self-employed individuals' retirement plans, such as solo 401k. So in that landmark guidance, for example, there's a chart on page 3, which makes clear that if the plan is established by the end of the year, the deadline for all types of contributions, whether employee versus employer, is the tax return deadline, including any timely filed extension. And this makes sense from a policy perspective, because a lot of self-employed individuals may not know exactly what their self-employment income is until after the end of the year, right? They might have a seasonal business where there's a lot of work being done at the end of the year. And since your ability to contribute is a function of your income, right? You can't save more than you earn. You need to know exactly what your income is before you can determine exactly how much you can contribute. So therefore, it makes sense that you would have additional time to make those contributions. So the key is really just making sure that if you don't have a plan for 2024 and you want to make contributions for 2024, that you sign up with us by the end of the year, because that'll preserve the ability to make all types of contributions, whether it's employee versus employer or voluntary after tax, all the way up until your business tax return deadline, including any timely filed extension. So you have plenty of time to determine how much you want to contribute, open up accounts, etc. Great question. I would like to roll over a regular 401k from a previous job to my solo 401k, but I would like to add my wife in the solo 401k, but she will be 60 years in December 2024. Can she still be available to participate? So great question. So first of all, you need to be eligible, right? So as long as both individuals are working in the self-employed business, they're both reporting earned self-employment income, whether it's separate Schedule Cs or a separate W-2 for each, for example, for a business that is taxed as an S corporation, each spouse is going to be able to participate in the plan, roll over funds from a previous employer plan or a non-Roth IRA, make contributions based on their self-employment income, and there's no upper age limit, right? So even someone that's 60, as long as they have that self-employment income with no non-owner, non-spouse employees working for them, they'll be able to set up a solo 401k. And then once they've set up the solo 401k, our plan will allow them to transfer money from a former employer plan. And we help with that transfer process, right? We'll prepare the transfer paperwork, guide clients through the process. That's part of our services, whether it's for an existing client or someone as they're being onboarded. And as you might imagine, the process will vary tremendously from one administrator for one 401 former employer plan versus another. And we've tracked all of our experience and that knowledge just to make it easy for new clients going forward to be able to leverage that experience and knowledge to make it easy for new clients going forward or existing who want to roll over more money to their solo 401k. So did voluntary after-tax contributions go up as well? Effectively, yes, they did, because the overall limit increased. So the voluntary after-tax contribution limit is 100% of the self-employment compensation, dollar for dollar, not to exceed the overall limit, right? So we saw on the slides, right, for 2024, the overall limit is $69,000. For 2025, it went up to $70,000. So yes, if you have the self-employment income to justify it, additional voluntary after-tax contributions can be made. Should the employer portion be 25% of income or 20% of net income? Great question. So it depends. So the ability to contribute to the plan is a function of the self-employment income. So what the self-employment income is will depend on how the business is being taxed. For example, for a business taxed as a sole proprietorship, self-employment income is equal to your net income on Schedule C, line 31 specifically, less 1/2 of the self-employment tax. So if, in that case, the employer contribution limit is 20% of that self-employment compensation figure, provided that all the contributions made to the solo 401k, whether employee, employer, and or voluntary after tax, doesn't exceed the lesser of self-employment compensation or the overall limit. Whereas if the business is taxed as an S corp or a C corp, self-employment income is equal to the W-2 wages received from the self-employed business, specifically box 1 of the W-2, plus any pre-tax elected deferrals not in box 1, but instead reported over in box 12. So in that case, the employer contribution limit is 25% of those W-2 wages. Again, provided that the sum of the employee, employer, plus any voluntary after-tax solo 401k contributions do not exceed the lesser of those W-2 wages, the self-employment income, or the overall limit. Good question. I already contributed the maximum 23,000 elective deferral plus catch-up to a TSP. What is the remaining limit for voluntary after-tax contributions for in-plan conversion to the Roth solo 401k? So unless someone has made contributions to a 403b, if you make contributions to another plan sponsored by an unrelated employer, such as a TSP, those employee contributions will not reduce how much the individual can contribute to the solo 401k. So, assuming that you have the self-employment income to justify those contributions, and let's assume you only make voluntary after-tax contributions to the solo 401k, you could contribute, for example, up to $69,000 as a voluntary after-tax contribution, right? Let's assume that your business is taxed as an S corporation and you have at least $69,000 in W-2 wages from your S corporation. You could contribute 100% of those W-2 wages dollar for dollar as a voluntary after-tax contribution, notwithstanding the fact that you also made employee contributions to your W-2 employer-sponsored TSP. And then you could convert those funds, transfer those funds from the voluntary after-tax solo 401k account to the Roth solo 401k account. So at the end of the day, you had $69,000 in your Roth solo 401k. Great questions. I have a cash balance plan for 5 years and just added the 401k profit sharing plan in 2023. Am I able to transfer those accounts to your company? So you're going to want to, so yes, our plan would certainly allow those types of funds to be transferred over, but you definitely want to check with the defined benefit plan provider to make sure you're eligible to roll those over to the solo 401k. And we can help complete any paperwork that they ask you to complete to initiate the transfer. So, yeah, great question. I mean, we definitely have a lot of individuals that have both a solo 401k as well as a defined benefit plan. And the key takeaway is that if you want to preserve the ability to maximize contributions to the defined benefit plan, the employer contributions made to the solo 401k cannot exceed 6% of the self-employment compensation. So recall that we talked about, for example, that the typical employer contribution limit, for example, for a business tax as an S corporation is 25% of the W-2 wages from the self-employed business tax as an S corporation. But if that individual also has a defined benefit plan and they want to maximize how much they can contribute to their defined benefit plan, they'll need to make sure that at least the employer contributions to the solo 401k do not exceed 6% of those W-2 wages. Now, they could still maximize employee contributions or voluntary after-tax contributions, subject to the limits, et cetera, to their solo 401k, and that won't reduce how much they can contribute to the defined benefit plans. So our plan certainly does support that structure, although we don't offer defined benefit plans. We can most certainly introduce you to a provider that does. So if the plan, if you simply just open an account, for example, let's say you open an account at a basic brokerage and then you discovered that you're not able to make mega backdoor Roth, you're not qualifying for the tax credit, you can't invest in alternative investments or take a 401k loan, et cetera. But you never just funded the account, you just maybe started the online process. They opened up, they assigned an account number. You could simply just send a message to that provider and just instruct them to close the account, just cancel it. Now, if you had previously funded the account and there just doesn't happen to be any funds in at this point, then that'll be a different process. In that case, it would be a restatement. So the plan would continue, but now be governed by our IRS approved plan documents. We would help open up accounts for the restated plan at the bank or brokerage of choice. Of course, there'd be nothing to transfer over because there's no funds in that pre-existing solo 401k. And in the case of a restatement, which is very common that folks will start out with a basic plan somewhere else and then upgrade to our plan to take advantage of the service and features of our solo 401k. But when someone's restating a plan, the plan is continuing. So there's no 5500 EZ that needs to be filed on account of that upgrade. There's no 1099-R that has to be issued on account of the transfer to the new accounts for the restated plan, et cetera. Hopefully that helps. Thank you for the good question. To my understanding, there are three components of contributions to a mega backdoor Roth. Where each of these components are formed. For example, Vanguard. Well, so with the mega backdoor Roth, or with our plan, I should say, our plan supports all different types of contributions that are allowed under the rules, whether it's pre-tax to reduce your taxable income now, or Roth, or mega backdoor Roth contributions, with the latter two, of course, having that potential for tax-free growth. So if someone's going to have all three types of funds in their solo 401k, they need to have three different accounts. And if there's two participants in the plan, let's say it's a husband and wife, now there's six accounts. So I'm understanding you're asking whether the accounts can be opened up at Vanguard. So Vanguard doesn't support accounts for third-party plans. They haven't for many, many years. And then, of course, more recently this year, they decided to exit the solo 401k business altogether, selling their accounts to Ascensus. But there's a lot of other good options, such as Fidelity, Schwab, just to name a couple. I'm the co-owner of a C Corp and also an employee who gets paid via W-2. Say I fully contribute $23,000 with my after-tax income by December 31st. Say also that my total W-2 income for 2024 was $100,000, out of which only 50 was from this particular job. What's the max employer contribution to the 401k? So I'm gathering here that you have $50,000 of W-2 wages from your business, right, from your C Corp. And then you also have another $50,000 of W-2 wages, maybe from a W-2 job, right, from an employer where you don't own that employer like you do with respect to the C Corp. So you can only use earned self-employment income to justify contributions to the solo 401k. You can't use W-2 wages to justify W-2 wages from a day job to justify contributions to the solo 401k. So in that case, your ability to contribute would be based on the $50,000 from your self-employed business. So you would take box one of your W-2 plus any pre-tax elective deferrals not in box one. So let's assume it was 50,000 when you added those two numbers. So in that case, your employer contribution limit would be 25% of 50,000 or 12,500. Great questions. I have LPL accounts with Ascensus. Can you just restate to your plan and keep it there still? Yes, that's very common in our customers. We definitely have plenty of customers that have accounts at LPL. We have plenty of customers that restated from Ascensus. The key question is whether or not an EIN number was obtained for the solo 401k. If yes, when you restate the plan, you could use the same name associated with that EIN number. This, again, is an EIN number specific to the 401k, not an EIN number for your business. And in that case, if you do have an EIN for your 401k already, you could keep the same name, keep the same EIN. And if those accounts at LPL were set up under the name and EIN number of the solo 401k, and to the extent that you have different participants, like say a husband and wife that are both working in the same business, or different types of funds and those are all kept in separate sub-accounts at LPL, then you could just keep this account set structure as is. Now, if you don't, it's really a simple process. It would just be a matter of opening up new accounts at LPL, or maybe LPL can simply update those existing accounts, right? We would obtain an EIN number for the plan as part of the onboarding process, and then you could just provide that EIN number to LPL, or they could open up new accounts at LPL under the name and EIN number of the plan, and then transfer the cash and assets over from the pre-existing accounts to the new accounts. That transfer is not going to be taxable. It's not going to be reportable. It's just going to be a transfer from pre-existing accounts for the plan to new accounts for the same plan, but just that's now associated with the restated plan documents. If I have the voluntary after-tax account at Schwab and want to use the mega backdoor Roth, is it difficult to roll the voluntary after-tax funds to my Roth IRA at Vanguard? Or should I start a Roth IRA at Schwab where the 401k accounts are at? So in our experience, it's going to be most easy to simply transfer the after-tax funds from the company retirement account, from the brokerage account at Schwab to a Roth IRA at Schwab, because that'll be an internal electronic transfer, and then contact Vanguard and instruct them to retrieve those cash and assets from the Roth IRA at Schwab, which they could do electronically almost always through the ACAT system. So if that's the case, a new EIN would be obtained as part of the restatement process. We would obtain that as part of our onboarding, and then we would provide that to you. And then you could simply provide that to LPL, ask them to update the accounts, or maybe your advisor at LPL would, depending on whether they want to open up new accounts or just update the existing accounts. Since the solo 401k contribution will depend on the W-2 wages, and the wage amount will depend on net earnings, which I may not know till the end of the year, do I need to pay myself W-2 wages by December 31st for contribution? Well, ultimately, you need to just make sure that you have a W-2 for 2024, right? A lot of times folks don't get their W-2 until January, even at a job. And then that W-2 wage justifies the contributions that you want to make. All right, that looks like it takes us to the end of the question so far. Thank you so much for the great participation. We do appreciate it. Please subscribe if you're on YouTube. Please like if you're on YouTube. Please join our community. Again, we go live every day, 1 p.m. Pacific, 4 p.m. Eastern, with office hours style sessions. We have the more prepared content like we did today, talking about the 2024 and 2025 contribution limits, typically on Fridays on our YouTube channel. We appreciate the chance to go over these topics. So if your plan, the $1,500 tax credit is not just for new plans. If you have an existing solo 401k, let's say through a basic brokerage like a Fidelity or Schwab, it can be upgraded to our plan, which will now include the features, the notices, the forms that are required to make the self-employed individual or business eligible to claim those $1,500 in tax credits. It's $500 per year for 3 consecutive years. So if the plan is restated here in 2024, the business will be able to start claiming that credit when they file their 2024 taxes, and then again for 2 more years for a total of $1,500, as long as they maintain the plan with the automatic contribution feature, which is the feature that makes the plan eligible for the tax credit. If I have a W-2 job and maxing our $23,000 plus catch-up, the employer is matching 3%. Can I still contribute as employer to my solo 401k? Should my W-2 employer catch-up count against the solo 401k max limit? So no, the employer contribution limit to the solo 401k, as well as the voluntary after-tax contribution limit to the solo 401k, is not reduced by contributions that are made to another 401k plan sponsored by an unrelated employer. So for example, if somebody has a 401k at a day job, the fact that they maxed out employee contributions to that 401k, or the fact that the employer made matching contributions to their day job plan, has no impact to the ability to make solo 401k contributions. The only exception to that is if that other plan is a 403b plan, in which case you have to aggregate. But if it's not a 403b plan, you can max out to the solo 401k, based on your self-employment income, right? You still have to have the self-employment income to justify the contributions, but you don't have to aggregate for purposes of determining how much you can contribute to the solo 401k. All right, well, we'll give it another moment to see if any more questions trickle in. Hope everyone has a great, if it's a 403b plan, then you do have to aggregate. So the sum of all contributions that are made to the 403b, whether employee or employer, together with any contributions that the individual wants to make to the solo 401k, cannot exceed the overall limit. So again, the sum of all the contributions made to the 403b, whether employee or employer, together with any contributions that they want to make to the solo 401k, cannot exceed the overall limit. For example, $69,000 for 2024. All right, you guys are great. Thank you for the great questions. Until next time, everyone. Oh, here we go. Last one. Looks another one came in. I just opened a 401k at Schwab for me and my wife. On my account and my wife's account, I see that we have the same 3 accounts with the same account numbers. So yes, I would assume that your wife's accounts are not set up yet. You could send a secure message to Schwab and ask about that. And please don't hesitate to reach out so we can help resubmit to Schwab, for example, if necessary. No, thank you so much. Appreciate you bringing that good topic up. All right, take care, everyone. Thank you.